this is Oliver Caminos, broker of St. Germain Properties. In 1789, Benjamin Franklin said, "In this world, there's nothing certain except death and taxes." Now, he said this at a time when there was no income, payroll, or corporate tax. Go figure. So let's talk about 3 strategies that our clients use to avoid, not evade, paying taxes when buying and selling real estate. Now, I'm going to preface this by saying that I will review these strategies with my clients in general terms or suggest that they inquire about them, but always review this with a tax professional. The rules are complicated, they change, and the IRS penalties for not following those rules are severe. So the most commonly used strategy is the primary residence exemption. So if you've lived in your home for 2 of the last 5 years, the IRS will allow you to exempt the first $250,000 of gain in taxes. That goes up to $500,000 if you're married. So I've had clients who have made a small fortune buying and selling homes every 2 to 4 years and avoiding those taxes. You can get creative with this. Let's say you have a beach property, you've had it out for rental. You can actually move into it for 2 years and then sell it to avoid paying up to $500,000 in taxes. Conversely, you can live in a home and actually rent it out for a little while and then even move back in if you want to or not. But so long as you've lived there for the last 2 of the 5 years, you can avoid those taxes as well. The second strategy is the 1031 exchange. This is more complicated. And again, I'm going to really advise that you seek advice when you're going down this road. But a 1031 exchange allows you to take one property that you hold for investment, not your primary residence in most cases, and then you sell it. You don't touch the proceeds. They're held by a 1031 exchange intermediary. And then within 45 days, you have to identify up to 3 potential homes or properties that you'll buy. And then within 180 days from the sale of your investment home, you must close on one of those properties. It can take a few variations. One is a reverse exchange where you actually buy the new investment property before you sell yours, and you still have to sell yours within that time frame I just talked about. The third is commonly is a Delaware statutory trust 1031 where you sell your home. It goes to an intermediary who will invest that into a Delaware statutory trust that holds an investment grade, property, usually professionally managed and institutional grade property. These rules are very complicated. I've seen people who said they were going to do this with their primary homes or when they take a building and they won't go they'll buy raw land. You can really get into a lot of trouble. I mean, you totally write it off in your taxes, but if you get audited, your penalties might actually cause you to lose money on the investment. They're that severe. So the last one is depreciation. I have one of my clients told me, "Oliver, only a fool makes money on investment property, at least on paper." What he meant by that is that by using depreciation and 1031 exchanges, you can basically, hold investment property, make money on it, show a loss or a break even or close, and then when you go to sell it, defer the taxes. So with depreciation, the IRS will allow you to depreciate just the building portion, not the land portion. So if you buy, let's say you buy a beach property, and the building portion of that, just for the sake of round numbers, is $1 million. You're allowed to depreciate that over 27.5 years. It's a little over $36,000 a year. What that means is that, let's say you're making $30,000 in profit, cash flow from that property, you can actually show a $6,000 loss because you're taking the $36,000 depreciation expense every year. Now, when you go sell that, the IRS will make you recapture that depreciation because your home probably went up. It probably didn't depreciate. However, if you use a 1031 exchange, you can actually kick those tax consequences down the road, rinse and repeat. You can keep doing that. Now, I'm not going to get into inheritance issues. I will review those with my clients, living trusts and other forms of trust to avoid inheritance taxes. The reason I won't review that in this video is those rules change all the time, and I'd hate for this video to resurface 10 years from now when the laws are completely different. So if you have any questions about what we've just reviewed, talk to me or talk to one of my agents. We review these concepts in detail frequently. And until next time, I look forward to talking to you. I'm Oliver.